Well, you guys are connected through that.
She's trying to think She's trying to think of questions she's going to ask. She's never been on a first date.
She's going to try to trip us up.
She's pre-planning these questions.
I've never been on a first date.
The problem is she knows us both pretty well, so that's kind of like a curse and a blessing right there.
I've never been on a first date.
Okay, well, this is how it should be. Nice and normal like this.
Welcome to Stop Whining About Real Estate. Join us as we chat, sip, banter, and wine with the best in the biz. Grab a glass of your favorite vino, sit back, relax, and let's wine together.
Afternoon, everybody. This is Emmanuel St. Germain. I am your host for Stop Whining About Real Estate. I've got my co-host with me, Sarah Biernbaum, and a good friend of mine, Richard Schaffer. He's a field partner for United Financial, and he's also a PhD, an MD, an ABC. He's got all sorts of other stuff. So I know I didn't give you enough credit on the business accolades.
No worries.
So please tell us a little bit about yourself in a quick little background, Rich.
Sure. Obviously, you and I have known each other a very long time, more than 15 years, right? Pretty much.
Wow.
Feels like one of us has been doing time.
Back when Emmanuel looked like he was in a boy band.
Yeah, that's right, exactly. That was the first thing I thought when I met him. I grew up in Michigan. Obviously, you guys know that, but Midwest guy, and started in the construction industry, actually. My family was in the construction industry. And in Detroit, you have about two options, construction or the auto industry. That's pretty much the two check boxes. And I'm thankful that I worked in that space for a while because I did learn a good work ethic and, of course, resiliency when you're working out in the cold. But I knew it wasn't really what I wanted to do long term. And so I, just through serendipity, had a math teacher that liked me and told me I should subscribe to the Wall Street Journal. And I was in middle school, and I did. And it obviously changed the way that I looked at my career options, I suppose, at that point.
That's really cool.
Did you know that I did a little stint in construction?
I don't even believe that.
I know you guys can tell, the calluses on these hands.
What did you do for said construction company?
So if you recall, which I'm sure everyone does, where you were during 9/11, I was up on a roof. I was replacing a roof. I was doing some roofing contract work. Mm-hmm. And, I've...
So you were... You built roofs?
So I was working, building. How do we define the word building?
I don't know if he knows the vernacular at all. I'm really going to tell him.
No, so my good buddy Pete, and we call him Little Pete, was owned a company, and I was helping. I was like I wasn't doing the crazy stuff, but I was number two, and I don't remember. It was a long time ago.
What's a number two do exactly?
He got sandwiches and waters for the crew.
Right, exactly.
Made sure the
no, it was just two of us. So I had to. No, it was just two of us. I was in
guitar.
Don't forget, 2001. I was in pretty good shape at that point. I was
that's not what we were questioning.
Well, no, but just meaning that I was able to carry things. I was a laborer. I wasn't the skilled craftsman.
Now the truth is coming out.
I was the laborer.
Right?
The number two.
How long did you do this
for? Number two out of two. You know what I mean?
Who did number two work for? How long did you do this?
My buddy, Little Pete.
How long? Who did number two work for?
I was also his office manager, and we had put together it was one of my first landscaping type jobs. When you grow up in a small town, there's only so many jobs.
Yeah.
When you're starting out. So what did you do when you were a kid?
Cutting grass, pulling weeds, shoveling snow.
Okay. But so all for family then?
No, I had 16 grass cutting jobs in my neighborhood. It was my first little mini gig.
How old were you when this happened, this roofing experience?
The roofing experience, 2001.
Yeah, but you were not. You were in college.
No, 2000.
Because I was in college, so you were beyond college.
Yeah, but I'm a couple years older than you, and I started when I was younger than you.
Oh, got it. We're back to that. Okay.
Yes. But, all right, this isn't about us. This is about Rich. We've got Rich here, special guest. So let's talk a little bit. I know you've got an extensive history in the mortgage industry and financial and all of that stuff. So dab very quickly about your mortgage background, and then tell us more about what you're doing now and why you think it's such a great product for consumers.
Well,
and what the product is.
Sure. I appreciate that. I'll do all that. I think first, as I was talking about, there was a little bit of maybe, serendipity that happened along the way. When I was 16, I found, or was given, I guess, a book, and it was Common Sense by Art Williams. And it opened up the idea to me about the rule of 72, time value of money, compound interest, et cetera. And so I was so enthralled with that idea and the math of it and the finance side of it that I would literally be on job sites
The rule is 72 is you're not supposed to call them after a date for 72 hours, right?
Hey, listen, that could be an Emmanuel rule.
Does
I don't
that
know.
work?
No, that's too long.
No
They'll
comment.
forget about you by then.
When you're young, it does, but once you get a little old, like we're like, well, who was this again?
Yeah, I forget.
The banking rule has nothing to do with that, thankfully, but it talks about how long it takes to double money. So I literally was on job sites showing people the rule of 72 on drywall at coffee breaks. So my dad was convinced I was crazy at that point. But just through some different opportunities, I was working at a job late at night after hours at an office building, and it was a Merrill Lynch building, and it was, 6, 7 o'clock at night or something. And we were working very quietly, and I just kept hearing this guy talk, and I was so enthralled about what he was talking about. So he opened up an opportunity. He said, you obviously are, really interested in this stuff. Would you like to go to some big financial sales training seminar? And he's like, it's $1,000. I'm like, I can't do it because I'll take care of it. And he said, but there's one caveat. You got to be a professional salesperson, making over $100,000 a year. I'm like, how are we going to get around that? He goes, I'll work it out. Went to that seminar, 1,000 people, never done anything like it in my life, and won 3 days later. So I went home to my dad, and I said, well, that's it, Dad. I'm leaving construction. I'm going into sales. And my dad said in his great, inspiring voice, he said, well, that's great, son. We'll always love you, but you're never going to amount to anything. So that was the first pep talk I really got. And that really drove me. And the day I left construction, I told everybody, they said, maybe you won't make it, you'll probably fail, whatever. And I said, maybe you're right. But the worst thing that has happened is I'll leave and I'll fail, but I'll come back and be just like you. And I said, but you'll never see me again. And that's really what opened it up. So when I started in the financial side of it, Emmanuel, to your question, I was more in the insurance side first, intern with Travelers and worked with Smith Barney on the investment side. But the number one thing that I struggled with, because I didn't grow up with anybody knowing anything about money, being successful, even going to college for that matter. And I was really, really big on the financial education side of things. And so I started off in the financial planning side of it, but I kept noticing a consistent problem. And that was that the number one reason that most people aren't adequately enough insured or they're not aggressively enough invested is they just didn't have the money, obviously. So I thought, well, if I could get a mortgage license and I could restructure the biggest debt they have and I could make that money available in real time, I could redirect it before they spent it, before they bought a new car or went on vacation.
Right.
And then ultimately, the first mortgage company I started on my own was a financial planning company that also had a mortgage component to it. And so the education part of it was really, really huge. But that really was what got me licensed in 96 when I moved down here.
And let's not forget, it is only as of, I think, last year or something like that our Governor DeSantis implemented the financial the education piece for high schoolers. I mean, prior to this, the reason your average, American consumer is just they're financially illiterate.
Yeah.
They know very little as a general whole. Like most people just don't know a whole lot.
Sure.
And it's because until you buy your first house and all of a sudden, think about this. Like we didn't have, when I started, there wasn't social, like I started in 2005. Mm-hmm. There's no social media. There was no TikTok. There's no YouTube. You weren't watching anyone. You weren't watching Rich talk and explain to you what a mortgage was or watching someone like me.
Yep.
So, you had to just experience stuff.
Yeah.
And, not every experience is great for certain people depending on who's the salesperson, doing all the work. So I love the education piece. I think education is a big thing. And it especially, we've been talking a lot about doing content and a lot about, things like this where being put on the spot, being forced to ask questions, putting content, video of explaining something, people relate to us first before there's a sale that's attempted. Mm-hmm. And whenever you can have that happen, the relationship between the buyer and the seller of that interaction is just so much more profound.
Sure.
Right? I didn't have to. It's.
Well, they learn to trust you before they have a need.
We'll go back to dating real quick.
Oh, God.
It's the equivalent. It's the equivalent of you introducing me to a girlfriend of yours, as opposed to me,
which she would never do, by the way. So.
And I don't blame her. But it's as opposed to honestly, as opposed to walking up to a stranger somewhere, and that person's defenses are up. You know.
Well, that's why like what I just said, they get used to you, they trust you, they like you before they have a need for you. So you're not selling them on a weakness or kind of a vulnerability.
Right.
Right.
Well, they think they like you, but they don't know you. But yes.
Well, they like you
that's-
enough to continuously listening to you and be tuned in.
Right.
Well, but I think, too, I mean, to be fair, none of us like to be sold. There's one of the great expressions I heard is that everybody wants to own, but nobody wants to be sold.
Yeah.
And I think that sometimes we forget when we're professionals in the industry what it's like to be on the other side of that equation. And I think, there's another interesting thing. You were in construction for a period of time, too. For about
I don't know that we actually have to
can't
put this on my
actually use
resume.
it.
for
but-
about 5 minutes, okay? But my dad said something really profound, and he said, when you're a hammer, everything looks like a nail. And so because of that, when I got into the industry, I didn't want to be that one-trick pony from that respect, right? So I had like 13 licenses at one point because I wanted to know that I could provide the answer. The problem is then there's just too many moving targets. But, we've really lost our way, I think, in the industry because we become very transactional. And technology is a curse and a blessing. I have a young daughter like you, she's 14 now, and social media is like the devil when it comes to that dynamic with young kids. But for business, it's imperative. But it's made us very sterile. I was just telling one of the guys in your office that the single greatest impact I had when I had clients in my mortgage business was I called every single client on their birthday. Seems like the simplest thing in the world, but I physically called them, and I had well over 1,000 clients at that point. But it was the simplest thing in the world of, hey, I just want to let you know before I got too sidetracked today, I want to call and wish you happy birthday. Crazy part about that, though, is they would say, I can't believe you called me today. My own mother didn't call me today.
Yeah.
But then it would follow up with saying, oh, it's so good you called me because my mom's moving down from New York or I'm doing addition. It is probably the single greatest lead generator I ever had, but I earned that right because I was actually genuinely engaged, and it was long-term trusted advisor relationship. It wasn't a transactional loan officer agent.
I mean, that's how I build my business with all of the referral partners that refer me business and that come into us is I am not part of the transaction at all.
Right.
So I'm not even selling the transaction. I'm selling the relationship and kind of the, extension of me and how to help them grow their business and be a partner to them and be that sounding board to them and how I can, help benefit them.
I thought it's because you went out drinking with them.
And
I
in
thought
turn, they send business our way because they trust me, they like me.
Sure.
I'm always constantly contacting them. And then I have, a couple people that do a pretty good job behind me that take care of it from there when they send the buyer.
But this one, pretty good. Pretty good.
Yeah,
Decent.
That's not how I
He's
sell you.
okay.
I'm probably his biggest fan out on the streets when I'm talking about him.
Listen, you are. That's for sure.
You know what I did, Rich, in our CRM, which was, I thought, a genius move, right?
If you do say so yourself.
If I do say so myself. I absolutely, I didn't, I got it somewhere. I just don't remember. Oh, I got it from a podcast, actually. I was listening to a podcast, and I thought it was absolutely genius. And so I had Jared build it out in our CRM. And of course, nobody uses it because nobody dials their clients for their birthdays. But I have a whole spot where I see your birthday the day before. And the whole idea is to call you the day before and say, hey, Rich, I wanted to give you a call. I know your birthday's tomorrow. I know you're going to be bombarded with phone calls and love.
It's good.
But I wanted to be the first one to reach out to you and wish you a happy birthday, bud.
Emmanuel, I love that. In fact, one of the things that I learned from one of my early coaches as well that was beautiful, just like you said, is that I would never send Christmas cards for various reasons. Number one, lots of people do or they don't celebrate
Thanksgiving.
Christmas. But I would always send them Thanksgiving. That was the first thing I learned because you're beating everybody to the punch and it's very innocuous. And there was something about saying in the season of Thanksgiving, it seemed like the appropriate time to stop and say thank you for your loyalty, et cetera. And those couple of things that we did. But I'll tell you, going back, there was something that along the lines I realized, even with the clients I had, and I never missed a closing. I'd go to people's houses to get documents. I was really, really heavily engaged in the client side of the relationship. But I think a big part of that, like you and I have talked about, is because I started off as a financial planner. And one of the great strengths of our industry, one of the great positives in the mortgage and real estate space, from the financial standpoint, is that we get one pretty sizable commission if we do a good job with the client. The downside is we get paid once.
Right.
And so it becomes a sale, a transaction, an event. And we throw some into a marketing campaign, but there's not an ongoing relationship. When you're a financial planner, if you don't take good care of that client each and every month, they stop paying. And your income is predicated on it. You get a little bit up front and a lot over the next 5, 10, 20 years. So you're wired, not to use the example you said, but
it's a marathon.
If you're dating, there's a big difference, or you're trying to just hook up with somebody, or you're actually trying to get married to somebody. It's very different because you're investing in. I think, honestly, even realtors are going to hate me to say this, but a big part of what transpired with this new NAR ruling and so forth is in no small part to the fact that the last element in the equation that people were thinking about or lost sight of was the client. And that has become a really, really big problem. It's one of the reasons that I always send my mortgage business through you guys, because you are really engaged and you actually do operate at a really high level there. But it is an epic problem, and I think that if we don't make some course corrections, it's going to happen in the mortgage business too.
Again?
But to the point, I don't know. Well, so right now what they're looking at is what they're calling junk fees.
Yeah.
And part of the so this is a whole different discussion we can talk about, which is regulation. And it's regulation from people who don't have a clue because they're not involved. They don't do enough.
They're not in the day-to-day.
Right, the grind.
Well, they're not involved with it. They don't know what actually happens. They don't understand from a competition standpoint. They don't understand that the margin. So something called margin compression, and companies have to survive a certain way, and if not, we're not trying to become as centralized. You would need small independent mortgage bankers like what we are. You need mortgage brokers. You need all of these things. We don't want to be Canada that has 4 banks.
Right.
Right. And that's not competition. That's not capitalism. That's not what this country was founded upon.
Agreed.
So, but all right, we're digressing a little bit. Tell us a little bit. So we got some background on you, Rich. We understand you've been in the financial world. Obviously, one of your great strengths is relationships and maintaining relationships with clients, which in all industries is a major weakness.
Yeah.
Whether for the realtors, who I was going to tell you, by the way, insurance guys always do a great job with that for the same thing.
100%.
There's a renewal period every year. So because there's a renewal period on your policy, that's your opportunity to shop. So don't give them an opportunity to shop. Reach out ahead of time,
and
right?
on the life insurance side, there isn't that kind of environment. It's every single month.
Right.
So there's a really ongoing relationship, 100%.
Yeah. And so let's talk a little bit about some of what you've been working on most recently, your product in general. To simplify it a little bit, it's a debt consolidation tool. Is that what would you call it?
No, I would not say that, because that would give the connotation that we're actually consolidating.
I knew Sarah was wrong.
Right? Yeah. So I'll give you a little example. So we'll clean that up. I'll say,
as per usual.
Here's what ended up happening, and this is the genesis of it. But there's some very interesting math and financial aspects to it that make this relevant, that are important foundationally. First, I'll say this, Sarah. What would you say are the top 2 New Year's resolutions every year?
For most people, or me in general?
Well, that's up to you, but in general.
I would say in general, it's somewhere with making more money, saving more money, and then also there's a weight component.
That's right. Fitness and finance.
Great.
Right? Lose weight.
You summed it up better than I did.
Lose weight, get in shape, get out of debt, and save money. Here's the next question. Why are they the same 2 every single year?
Because people start off strong and then they taper off.
Right. They don't follow through. So it's not the whole they don't plan to fail, they fail to plan. They fail to follow through.
Correct.
It's their goals, too, by the way. So
For sure, but there's a psychological side to it that's
They don't have a
different.
system. Emmanuel wants them to have a system.
no, but sometimes what they do is people have too lofty of goals.
Or they don't set realistic goals.
Right. If your goals are too lofty and it's not attainable, it's too easy to give up.
Well, you get discouraged.
When you
It's not
don't,
gonna
when
happen.
there you go.
Yes, but there's another element to it that we don't think about. We could say that we lack discipline and fortitude and follow through. That would all be partially true. But the biggest reason is because we don't understand the relationship between what we're doing and the impact it's going to have tomorrow, next week, next month. Perfect example. To lose weight, you ready? Eat less, exercise more. That's how simple it is. It's not that easy, but it is that simple. But here's the problem. If I ask either one of you exactly how many calories you burned today or exactly how many calories you took in, you'd have absolutely no idea. But that's fundamentally what's predicated on understanding how to be able to manipulate that dynamic. Guess what else that applies to? Finances. Income does not spend less, save more. Easy peasy. Why is it so hard? It's not just because we associate spending with pleasure and saving with pain and eating with pleasure and dieting with pain. That is a big part of it. But it's because income changes all the time. Even if you're salaried, you could lose your job, you could get a tax refund, et cetera. But expenses change all the time. The washer breaks down, next thing you know, you need a new refrigerator.
The AC breaks down.
The AC breaks down, as you just had happen. Transmission breaks, kids, always. So guess what? These 2 things are always moving. Here's what's huge. Let's say, as an example, Now, if I ever figure out how to patent this, Emmanuel, I'm not going to know you anymore. I'm going to live on an island somewhere.
But you'll know
okay?
me, so it's good.
I'm going to know you for sure,
Perfect.
Sarah, okay? You left me hanging on that. But okay,
Sorry.
that's too late. Okay. So let's pretend for a second, and this is going to dovetail exactly into the methodology of what we're going to talk about. Let's pretend this is a magic fork for an argument's sake, okay? And every single time you took a bite of food, there'd be a gauge on that fork that would tell you exactly how many calories that bite of food was.
And then by the end of the day, it basically gave you your full count.
Okay, yes, and you could spin it around and you'd see a picture of exactly what you're going to look like in 90 days if you continue to eat that way. Do you think that would have an impact on your eating behavior?
Absolutely. It's like when you go to a restaurant that has the menu that has the calories on it.
You hit it. Now, here's the point. You might have one bite of chocolate cake, but you're not going to have 5 because now in real time you see the long-term impact.
Yes.
What if we could do that financially? What if somebody could know the long-term financial impact or implication of every single financial decision they did in real time? They would know the impact 5-10 years from now, what they just did 5 minutes ago.
You need that timer on Amazon.
All right, but let's pause on this,
Yeah.
okay?
There was that little ticker on my Amazon. I'm telling you, the packages would go down, down, down.
All right, so let's think about this,
Okay.
because it's very doable. I could get down to 3% body fat. I can get my body to be whatever it is. It's called bodybuilding.
Sure.
And bodybuilders, they know every single gram of protein and what they put in their bodies.
Okay.
But what percentage of the world or the country are bodybuilders? It takes such a incredible desire to want to do that, which is why so few people do it, right? So if we know it can happen in the common world. I'm just using your analogy.
Yeah.
I'm going to say the same thing back to you in terms of an individual wanting to fix their finances.
Sure.
If you give the tools to Sarah, what are the chances she's actually going to use it and follow it?
Well,
Now, I agree. I like the picture part, by the way.
High.
I agree.
Exceptionally high.
Here's why I'll interject. The bodybuilder part that you just described is somebody that needs to count their macros, their protein, their carbs. They work out. They know exactly what they're putting in their mouth. They all of that stuff. This fork,
Does
this
it automatically.
tool.
We're not talking about his fork.
No,
though.
but here's what I'm saying. Took the work out of it. So if you
How smart she is. She just got it
if
like
you
that.
had the same technology for your finances, and you had a tool that basically showed you if you're going to go out to dinner tonight and you're going to spend $100 on your tab, this is what the impact is.
That's
if
right.
you go buy all of these things off of Amazon because your kids just shouted from across the house, I want a new water bottle, I want
Yep.
this, I want this for school, and in the sake of just ease, you just went on Amazon and got it and it was going to be delivered tomorrow without any kind of concept of the long-term financial impact it was going to cost you. You just do
Sarah,
it.
I'm quite impressed.
But
That's
if I
very
had
good.
a tool, and I'm assuming this is where we're going
Sure.
that showed me what that Amazon purchase was going to do, what the dinner tonight is going to cost me long term, I would go, oof, maybe I don't spend $100. Maybe I spend $50 at dinner tonight. And you know what? We've got plenty of water bottles here. I'm not doing that today.
So let me illustrate what you just said, Sarah. First of all, that was exceptional in terms of being able to extract the general concept. And let's
send you
illustrate
invoice
this way.
later.
So I've ran to your bodybuilding example because Emmanuel obviously is fit and is very dedicated to workout.
Not at all where I was going with that.
I've ran 6 full marathons, but let me give you an example of why there's a mile marker every mile for 26 miles. Because if you don't see that you just went 6 miles and you're a quarter mile there, half. My first marathon I ran, I blew up my knee at mile 15. I finished it anyway because I'm stubborn and stupid, but
You knew how much longer you had to go.
I did, correct. Now, they did a study about 7-8 years ago where they removed all the mile markers after mile 15. Nobody was allowed to have a Garmin watch. 28% of the people didn't even complete the marathon, and all but 7% got the worst time they've had.
Yep.
Why? Because that mile marker, every mile for 26 miles, and the very first marathon I run, I'll never forget this. There was a big billboard at mile 20. That's what they call the wall. Your body's burned through so much glycogen, it can't replace it fast enough. And it said, I run because the mind is more powerful than the body. But being able to recognize the progress you've made, whether it's eating, whether it's running, or whether it is your finances, is everything. And I'll say one thing that I partially disagree with that Emmanuel said. I believe that the average person has a much, much greater likelihood for success than we envision if they actually see the impact. Let me illustrate this way. Let's say we put this table right here. Let's say that I put a $100 check on this table. You'd probably reach over and pick it up, no problem. What if I told you that you had to crawl on your hands and knees through crushed glass to get it? Not so much. What if the check was $1 million? Now you would, because you'd say, I'll sit in the hospital for a month and have them pick glass out of my knees for $1 million. So the point is, if the impact is big enough, you would be surprised what people will do. And so our whole point is, how do we create a visual representation of the impact of what they're doing in real time in an automated way? So let's take one other example, and then we'll illustrate how that applies in real life. 100 years ago, 200 years ago, the only way we could tell time was a sundial. Then it was a compass. My grandpa Schaffer had a compass on top of the dashboard of his Crown Victoria. And people didn't travel as much. They were local, et cetera. Then we came up with maps. Then there was Tom's Guide. And then remember MapQuest? MapQuest was fun. It was great until you got lost, because then you didn't have another computer and printer to print out the directions. But what does GPS do that is fundamentally different than all of that?
It recalibrates.
That's exactly right. Now, here's the point. Do you think the average person knows how this phone works?
No.
No chance. Do you think they actually know how GPS works? No chance. It's a global network of 17 satellites, 24,000 miles above the Earth. But hold that thought.
Did you know that?
The biggest impact is if we could make it push and play. My mom is 76, hates technology, but she can type in an address and push go. And when it says turn right in 200 feet, she can do it. And if she misses that turn, it says now you got to go a quarter of a mile. You added 2.6 miles and 3.1 minutes to your trip. She can do it. Our whole focus is we've now found a way to make managing finances and getting out of debt as easy as push and play, allowing the average person to bank like a bank at the push of a button. So it's literally GPS for money. That's what we've been able to do.
So love it. I agree with all of it.
Okay.
I'm going to play devil's advocate.
Oh, boy.
Please do.
Okay. Every analogy, everything we've discussed.
Dave Ramsey tried that too. It didn't work out too well for him.
Every analogy, everything we've discussed. I'm no Dave Ramsey, please. So what you've got is everything you're talking about is instant gratification, immediate gratification. Sarah going through pain in order to get the $1 million check. It's not. Now ask Sarah, would she do that if the check didn't come for 10 years, right? And so for me, the benefit, the financial benefits of going through this product, this process, I'm curious, and this is a question more than anything else, but all the other analogies that we've used to kind of demonstrate what it does, you're seeing an immediate thing, right? Whereas someone makes $45,000 a year,
Okay.
$65,000, $85,000, I don't care whatever the numbers are.
Sure.
You and I have always been in commission type structures where if we wanted to make, but meaning that if you want to go make an additional six-figure
work harder.
income, we just work harder.
That's right.
We open more doors,
right.
And it's an opportunity for us. For a lot of people, most people, that's not necessarily
very true.
An option for them. So you can't take here, I'll just make an extra $50,000 next month and I'll pay all that down. And then you see a really large change.
Sure.
So in a person an average American who's making 65, I don't know what the average salary is, but it's called
$60,400.
There you go. See, with inflation, I was close. So with these tax cuts coming up, we'll be back right back down. No, just kidding. So but honestly, so like if you take a 65,000 income individual, how is their psyche going to see the end?
All right, here's how I'm going to blow you away. That was very well said. And this is why we tend to look at things financially. And I got to segue for a second because it's important. We look at things two-dimensionally. Now, first and foremost, let's establish a very clear reality. There is a reason that banks and financial institutions are the biggest building in any city, in any state, in any country you'll see in the world. Two reasons. One, it is the golden rule, but it's not the one you learn in church. It's he who has the gold makes the rules. Possession is 9/10. They have the money, and they know what to do with it. Now, this isn't about bashing the banks. It's about how do we emulate the banks, because imitation is the greatest form of flattery. So let's talk about how banks actually make money, because it's not the way most people think. We look at it two-dimensionally. So here's a perfect example. Real estate. What do they always say the big three are in real estate? Location, location, location. In the mortgage business, it's interest rate, interest rate, interest rate. In the car business, it's payment, payment, payment. Well, we've all seen The Wizard of Oz, right? We think it's this almighty Oz, and it's some guy just pulling levers behind the screen. Magicians do something very powerful. Look here, because I'm really doing this. Here's what's happening in the financial business.
I thought we were talking politics. Sorry.
No, I segued from politics.
No.
Way too dangerous.
Look here while I do this.
While I do this. That's what I was saying.
That too, yes. I'm sorry. I don't want to go down that road. But the whole point is money does not work the way people think. So here's a perfect example. So Sarah,
Yes.
let's say you had a 6% credit card for a moment, okay, and a 6% line of credit, a 6% car loan, and a 6% mortgage. Now, on the surface, they all look the same, but they're not.
Nope.
Because it's not interest rate.
Whoa, don't tell. Let's set her up for this.
Why are we? Okay, fine.
No, I'm gonna make her play. You watch.
Okay, I'm
So
fine.
it's not interest rate. It's how the interest is calculated, how the finance charges are assessed, and how and when the payments are applied. That's what dictates true interest volume, or we refer to as effective interest. I'll get back to that in a minute. But let's say you run up a $10,000 balance on your credit card one month. You're a little bit of retail
Amazon
therapy.
crazy. Got
Okay,
it.
yes, retail therapy. And if you pay off that balance before the end of the month, how much interest do you pay?
0.
That's right. Now, in that case, though, did the interest rate matter at all?
No.
Whether it was a 0% interest rate
matter.
or 29.9, the interest so the interest was not even relevant there.
Correct.
Let's take a line of credit, personal line of credit, business line of credit, home equity line of credit. You borrow that same $10,000 on the first, you pay it off on the 17th, the 24th, whatever it is. Do you pay 0 interest? No.
No.
It's average day. I'm bailing
I've
her
never
out.
taken one of those.
It's an average daily balance. But what that does mean is you're no longer paying 6% interest on $10,000. You're paying the equivalent of 2 or 3% on that $10,000. But again, that means interest rate was not the most operative factor in that loan. It's how that loan assessed the finance charges.
Okay.
Car loan, you could have, let's say, a $500 car loan, for argument's sake. $100 in interest, $400 in principal, whatever the case is. That's a pretty steady schedule because cars by default depreciate, so they can't be built the way other loans are. Let me tell you, by far and away, and this isn't a negative, and I'll go full circle in a minute, the most expensive loan you will ever have in your life by far is a mortgage. And here's why. It's not just because it's generally the biggest loan you have, because it is. It's not just because it's the longest term. It typically is. It is because inherently how that loan is designed to calculate interest. There's a reason it takes 21 years on average to pay off half of a 30-year mortgage. That doesn't seem to make mathematical sense because it is inherently front-end loaded. Now, let me give a little trivia here. Back in the 1940s, prior to that, you had to put 80% down and banks would only finance 20%. And then it was a 5-year balloon. Post-war era, they expanded those to longer loans, i.e. 30 years. But they did something prior to that most people don't know, which is that they consulted with the U.S. Census Bureau, and they realized at that time, the average person lived in their home 7.2 years. So guess what they did? They structured the loan in such a way where as much interest as humanly possible would be levied against the client during the entire period of time they would typically live there. That's why the system is rigged against us. So the whole point of it is, if you take your mortgage statement right now, and you separate the escrows for taxes and insurance, you just look at your P&I, your principal interest, and you divide the amount of interest in that payment. That's going to tell you what you're really paying. And it's not 3, 4, 5, 6%.
Oh, I'm
it's
aware.
40, 50, 60, 80%. Now, here's the point of why I'm saying this. There is a way to game the system strategically using the examples I just gave you. If you knew to the penny, to the day, exactly which debt to pay off, how much and when, you could cancel tens, if not hundreds of thousands of dollars in interest. But you got to do 4 things. Strategic payoff. You algorithmically need to know exactly which debt to pay, how much and when. Number 2, there's interest float, which we just talked about. But it's how to maximize the leverage use of interest float.
Okay.
Number 3, interest accumulation. Small amounts of money do accumulate over time if leveraged strategically and efficiently. But last but not least is probably the most important, but it's the one that people understand the least. It's interest cancellation. Even Dave Ramsey did not understand this when I first did his show 15 years ago. He said, no, the interest is contractual. You have to pay it. I go, that's not true. Because amortization schedules, contrary to popular belief, are not based on payments. They're based on balance points. It just so happens it takes X number of payments to get to that balance point. But if you did, you could eliminate years of principal interest payments and therefore tens of thousands of dollars in interest, just illustrating that. So let's say you had a $200,000 mortgage and you paid $5,000 down on it. Forget about where that comes from for a second. Well, of course, now you have $195,000. Well, but what you're not realizing, though, is that you now eliminated every single payment for principal interest it would have otherwise taken to get to $195,000, which means you might have eliminated $15,000 or $20,000 worth of long-term interest and payments with your $5,000. And by the way, it's guaranteed and it's contractual. Now imagine doing that with every single debt you have simultaneously. Now, to your point, I could do this with somebody that has as little as $1 of discretionary income. Let me tell you how. Because it's not just randomly and haphazardly directing more money to principal. It is strategically, just like GPS. It is taking into account
directing you.
That's directing you specifically. So here's what happens. Remember,
Fred, show me the money.
All debts are not equal. So it's a matter of saying, how do we prioritize them? So Dave Ramsey does something called snowball, pay down the lowest balance. People call the avalanche theory, pay the highest interest rate. But remember, is your credit card really your highest interest rate? So then you get into things like called velocity banking, where you're leveraging your income. So let's say you have an average family making $5,000 a month. So glad you said that, because here's how we dispel that misnomer. Because here's what happens. We've all been convinced to become loaners of our money, not owners. We don't actively deploy the use of our money to our advantage like the banks do. Because every dollar needs 3 jobs: cancel interest, pay down debt, and or accumulate interest. Because that's how banks make money. They don't make money on the margin. They make money by leveraging that money, volume and velocity, and deploying it in real time. But now we can help somebody do it using a system that helps them to do it. Now, to the other point you made, which was very good, if you had a dashboard, just like GPS, when you're running 6 minutes behind, what do?
Go faster.
You drive faster. What if you could know that exact same dynamic financially? We could take the average client without refinancing them. And again, there's an advantage to refinance. That's a different conversation. But without having to refinance, without paying biweekly, without paying money randomly and haphazardly to principal, we could probably eliminate every single debt they have with the same money they have in probably 8, 10, or 12 years. And subsequently, probably eliminate $100,000, $150,000, $200,000 of interest. And guess what? It's guaranteed, because math does not lie.
How much of this is predicated on having additional funds?
Okay.
Because I would go back to you and say the person who makes $60,000 spends $75 to $80 a year. I think the reason...
Well, they can't be upside down. It's math. But they can be tight.
Well, they can be in
upside
debt.
down. What's the?
It's not magic.
We have 1.4 trillion in credit card debt.
But it's debt service. Now, let's talk about that. So here's an example. Let's say the average family makes, we'll say $5,000 again a month, okay? And their fixed expenses are $4,000. Car payment, mortgage, et cetera, et cetera. And then they spend an extra $150, $300 a week going out to dinner, go to the movies, whatever. Okay, we know they spend 90, 95% of it. Guess what? Newsflash. 91% of all bank accounts are currently in non-interest-bearing accounts. You want to know why? Because they think, if I only have $300, $400, $500 a month left at the end of the month, how much interest could that possibly be? Here's what they don't realize. That is not how banks make money. They leverage 100% of your entire deposit and any remaining portion of it every single day until you spend it, and put it to work to cancel interest, earn interest, or pay down debt. So now it's not if they have an extra $100 a month. It's weird strategically leveraging the benefit of their monthly positive cash flow and discretionary income every single day until they spend it.
So I have a question. So I think we can go into like the depths and the reasons and the explanation of this for days and days on end.
Yeah, it would be a follow-up podcast for sure.
As the average consumer who's clearly never taken out a home equity line, and what else?
Average Sarah, we'll call her.
Average Sarah, who's, has a pretty basic understanding of my finances.
Or basic Sarah works too.
Who has her her first mortgage as a later adult, and really like my only financial kind of understanding is my mom taught me how to balance a checkbook, and they kind of taught me banking and everything else. So I'm just a regular person. I do have some credit cards. I have a mortgage. What is this something that's out? Is this something that's like able to be?
We first did a test pilot for it in 2004.
Okay.
Now, granted, to Emmanuel's point earlier, technology has come a really, really far away.
And my second part of the question, I'll let you finish answering, is how complicated is it for the average user, standard Sarah, to go in and set up and do, as opposed to somebody like you folks who have been in the financial world for at least 40 years?
Well, first of all, we have about 100,000 clients currently.
Hold on. You heard the dig, right?
I dig, and I
know it's not true of me, but I feel like she's picking on you on that.
I look directly at you on that one.
I love Sarah, so I'm going to say this. First and foremost, this is the thing we're most proud of. And I'm going to make this statement, and we can back it up. We're going to fundamentally change the way that America manages their money. And let me tell you why. For the exact same reason that 99% of the population sucks at navigation.
Okay.
But they can. So here's the question to you. Do you have social media?
Of course.
Do you know how to use it?
Yes.
Do you do online banking?
Yes.
Do you know how to text people?
I do.
Can you send a picture through your phone?
I can.
You know how to use GPS?
Yes.
You're golden.
Great.
So our whole point is, I don't care whether they're 18 or 78. The oldest client we have currently is 84 years old.
Okay.
Here's what I do know for certain. My mom, she's going to see this, I'm going to get in trouble. I love my mom to the moon and back. The worst thing I ever taught her how to do was text message, because now she texts me all the time, okay? She's the least tech-savvy person on the planet Earth, and she'll tell you that. But she does online banking. She knows how to plug an address in to go to GPS, and we've made it that simple.
Awesome.
If we can make it plug and go, because here's the point. When GPS says, Sarah, you've got 18 minutes to go and you need to turn right in 400 feet, can you do that?
Yes.
So if the system said send $374.12 to this debt on the 14th, could you do it?
Yes.
You're in.
Great.
And by the way, we guarantee the results of the product. Can I
Sign me up.
guarantee she's not going to quit her job or throw her laptop in the lake? But we guarantee that the numbers absolutely are verifiable and they have access to it for life.
That's awesome.
There's your answer.
What's the product called?
It's called the Money Max account.
Okay.
Yeah, so we're maximizing the leverage use of money.
I get it.
Exactly.
Money Max account.
We have
Is there a
different
website
variations
for
of it.
people to go to see this?
Yeah, there's some content we'll put specifically for this, but right now Money Max University is the YouTube channel and the social media handles that we're using.
Okay.
But the thing that I will say, and this is why I love working with Emmanuel, because he's genuinely one of the smartest guys I know in the industry. But I'm going to say this right now, and I say that sincerely.
Ding, 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 ding.
Listen,
Ring the bell.
When we're out hanging out as friends, I'll dig on him like crazy. But professionally, I got to admit, he knows his business. But I'm going to say this.
Fair.
Emmanuel, what is the number one reason that clients aren't refinancing right now?
Okay, so it's a good question. Well, because they anticipate rates going lower, so they're trying to time the market.
So rates are higher. A higher interest rate is the number one challenge, would you say, quantifiably?
Oh, sure. If she has a 3 or 4%, it doesn't make sense to refinance into a higher interest
Now,
rate.
coming from the financial planning perspective, and I know you know this because you and I have talked about this. First of all, let me give you the negative first, okay? 73% of all consumers that refinance that have more than 23 years go back to 30 years. Okay? So let me talk about the negative, and let's talk about the positive. Here's the negatives about refinancing.
By the way, that's to my point of what I was suggesting about the financial savviness of an average consumer.
Or how they're led by companies.
Well, we literally, so one of our loan officers, I literally showed him, I gave him 4 options for a client.
I remember you told me this one, yeah.
This is just the other day.
Yep, you told me.
Save $750. He's been in a loan 1 year, exactly 1 year. Save $750 going back to a 30. Save $699 staying at a 29 year because it's a common misnomer that you have to go back to a 30 year. We can do a 22-year fix. We can do anything you want. So we offered a 25, which I think was like a $450 in savings. Or we could go from 29 years all the way down to a 20-year, and it was costing him $50 or $60. Take a guess which option the client chose. They chose to go all the way back for the max savings, which, and again, it's not so. I am not hating on the consumer. The consumer is my client. I'm simply stating that all consumers rarely do what's in their best interest.
We know you're savage. It's okay. You could just
admit it. No, it's not that. It's just consumers don't do what's in their best interest, just like patients don't do what's in their best interest.
I'm going to do you a huge favor right now.
Look at the people who smoke cigarettes, even though
Who smokes cigarettes anymore?
Even though you have pictures of like the crazy, like that's part of the scare tactic, part of what they're doing. So I want to be optimistic. I want every consumer to have zero debt. I want all consumers to use your product.
Okay, so here, I'm glad you queued that up.
Companies are going to come for you.
Well, first of all, I know the banks probably hate us, but let me say this. I love that. I'm a very anti-establishment guy, and when you got to change the world, you got to kick some ass. But let me say this. 3 negatives of refinancing, not that they have to, but across the board is you're going to extend the period of your debt 7 times out of 10. Number 2, you have to add cost to it. So if you add 4, 5, 6, 8 years, whose advantage is that to the consumer or the bank? The bank. If you add 4, 5, 6, 8, $10,000 in cost, the bank. But here's the worst part. You're resetting the clock on that front load interest back to 0, which means you could take somebody from a 6% loan to, say, a 3% loan, and guess what? Their interest volume just went up. Have you ever wondered why banks, I'm not talking about loan officers structuring the debt. You ever wonder why banks want to actually have an appetite to refinance you to a lower rate? How could that make mathematical sense? It's not just about reselling it and all that. It's because their actual interest volume on each payment went up, even though their note rate went down.
Only assuming they went back to
For sure.
back to the term.
Correct. But here's the beautiful part.
So if we were going to, because we are a mortgage company.
Of course.
So if we were going to give advice, the smartest way to refinance is to never go backwards, at least in a market like today, where everyone in the last 2.5 years has a rate above 7. Right, so all those individuals that are going to refinance into a lower interest rate, they should at least stay at their current term or shorter in order to not give the quote-unquote banks more power, correct?
Let me blow your mind on this. Under normal circumstances, yes, because it's the only option they have. If they're deploying the use of our system, no. So let me give you an example, because it's all driven by the leverage of cash flow to cancel interest. So here's a perfect example. In this scenario, I would tell a client, let's say, client, we're going to refinance her. Let's say you're at, 3%, 4%, okay? But guess what? The economy's bad. People have ran up a couple credit card debts, maybe a new car loan, et cetera, right? It's not static. Life is not going to stop happening. So you could make the argument, and you're exceptionally good at it. You could say, hey, your blended rate, you got a 3% mortgage, but you got this 22%, credit card, you got et cetera, et cetera. So we could show how we could reduce their weighted interest or their blended interest, for sure. But you can't even open up that conversation because in their mind, they're so fixated, I can't move that 3% rate. I get it. But what if I took that same client, Sarah, and I said, Sarah, this is probably not true with you, but you got a 3% mortgage, rates are 7 or lower a little bit now, and you bought a new car 6 months ago, you got this old student loan, whatever, okay? I'm like, we are going to refinance you to 7%. Yes, we're going to reduce your effective interest rate, your weighted interest rate, but now we're going to deploy this system, and we're going to pay off every single debt you have in probably roughly 10 years or less. Now, did we care about the fact that we went back to 30 years? No. Let me tell you something that's even bigger than that. We'll show you how we can reduce your effective interest rate, the actual interest volume you pay, to probably 2% or less. Now, if you could propose that kind of strategy for a client, again, I'm thinking like a financial planner. Remember, mortgages are a tool. So the number one thing people should look at is, I'm not trying to sell the idea of refinancing, but there's a massive opportunity to do it if they're going to deploy a system that's going to hold them accountable to strategically leverage that money to pay less interest and pay that debt off faster. And now what happens is, it's not just the mortgage. I'll give them the opportunity to be visibly debt-free, totally and completely every single thing they have in probably 8, 10, 12 years. And now here's the question. Sarah, if you were totally and completely debt-free and didn't know anybody anything in 10 years, how would that change your life?
Amazon.
Great. Do I still get that $1 million check?
No, I'm sorry, that's gone. But you see where you can fundamentally change an industry. And here I'll say this, and please forgive me, I know I probably shouldn't say this, okay? But I was up at a conference in Michigan, an EXP conference, that I was invited to attend, and it was at UWM's corporate office. Amazing event, some superstars there, some really superstars there. Great speakers, teachers, trainers, technology, marketing, blah, 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 blah. We get back in the green room like this with everybody that were speakers after, and they're kind of talking about their presentations, and they were really some very good presenters. So finally, one guy looks over at me and goes, so what do you think, man? You want to give us some feedback? I go, do you want it? He goes, do I? I go, probably not, but I'll give it to you anyway. I said, all the condemnation first, all the great stuff. I said, but let me tell you one thing now one person talked about. Not one person in 2 days talked about the client. They talked about how we can market better, we can attract better, we can do better lead generation, et cetera, et cetera. That's all great. And I'm sorry, realtors are going to hate me for this, but there's a reason that NAR ruling happened. Because somewhere along the line, people forgot about the consumer. Because what happens is, the first thing I said earlier is it becomes a sale, it's a transaction, it's an event, and it's over. What if that real estate agent or that loan officer introduced them to a system that could actually help them completely change their financial picture, get completely out of debt? You think that's elevated the status, the perceived value of that professional? Because now they become a trusted advisor, not just a transactional agent. Do you think the retention of that client would go up? You think more of them would come back for another loan, give you a refinance? Absolutely, positively, no question.
Well, there you have it.
Right back to square one. Don't be transactional. Standard Sarah. Don't be transactional.
It was kind of on purpose. I went full circle.
No, of course. I love it. I love it. Yeah. I love it. I think that there's a ton of information, and I also think that the tool sounds extremely valuable and super useful. And from what you say, very, very user-friendly, even for simpleton Sarah like myself.
You're not that simple, Sarah. I've worked with you. You're not that simple.
No,
you're more sophisticated than you.
It's totally okay.
Rich, what's the from the clients? Are you guys able to track how often your average users are going into the system?
Our average client is 16.5% ahead of schedule.
No, okay, but that's not what I was getting at.
Retention,
how often are
engagement?
simple Sarahs logging in and checking in?
Well, since we're so simple, we got to log in a lot so we can remember what's going on.
All right, so
how often do simple Sarahs click
PCness
forgot
aside,
password?
Okay, seems like we've gone down off the script of PC now. Do I have clients that are engineers, actuaries, really, really hyperbolic, detailed guys that log on and validate a pack of gum they just bought? Sure, a few, like
the
1%.
Emmanuels. Got
Okay,
it.
No.
Even he's not that much, okay? Do I get people that are much older and have less debt and a fixed budget that might check it once or twice a month? Sure. The average client logs on once a week for 3 to 5 minutes.
Okay. And we don't have to go into specifics, but are there packages to be a client? Is there a price point? Is there, because
Sure.
if you're making $65,000 a year, you're looking to help streamline your debt, your payments, maximize all of this stuff. I'm assuming that it's not an arm and a leg out of your $65,000 a year.
No, but remember, it's all about using the bank's money. So when you refinance, how many people pay those costs out of their pocket?
Very few.
They roll them into the loan. So how does that make mathematical sense? Well, because they're leveraging that loan with the money they can save. So when they do it, and you've done this a lot.
So it's rolled into their payments.
Well, they're purchasing it, but we're probably going to have them leverage a debt to do it because we can manipulate the interest they're going to pay on that debt.
Got it.
So as an example, 3 different platforms primarily. If you don't own a home or just don't have a mortgage, and you have credit cards, car loans, student loans, whatever, and you're under $80,000 in debt, that's one platform. Much less expensive, a little bit more simple. 70-80% of our clients have a mortgage. They can have unlimited debt. I've seen $2-3 million of debt, but they're maxed at 3 mortgages. Our investor level platform, you could have up to 99 properties. Case like that, we might be saving them $5 or $6 million in interest.
Got it. So packages.
Yeah, so package. So it depends on that, and it's all a very varied formula based on how much debt they have, how much interest we can save them, and how quickly we can help pay it off. So the more value we can give them, it's commensurate. The less, of course, it's commensurate. They can buy it outright. They can throw it on a credit card. They can finance it. We have various ways for them to purchase it, but we'll generally offset that cost in probably 1 to 3 months with the interest we'll save them.
Okay.
How long has the basic package been called Simple Sarah?
I'm going to want some payouts for this. That $1 million check better be coming to me soon.
He owes it to you, let me tell you.
I think we got
know
something
that.
here. Simple Sarah as the basic package. People will relate to it. It's very,
You work with
very
this guy every
average and
day?
common.
Unfortunately,
You have a
yes.
drinking problem yet? I mean, the stress has to be crazy, you know what I mean?
All right, so Rich,
Sure, buddy.
for anybody who's interested in learning more about the product,
How do they find you?
How can they get a hold of you?
We'll provide one of the things we'll do as a result of this relationship we have with you, and it's very reciprocal with a lot that we do. We first do a free educational webinar to give somebody a little bit more context of the details. We show them visuals and so forth. And then anybody that actually attends the webinar will do a free complimentary savings analysis. So they're going to see whether or not it makes mathematical sense. And if it doesn't, we don't suggest they do it. Of course, if it does, the answers are pretty obvious. So we'll actually provide a link that when you post it or whatever the case is, if they want more information, we host a webinar once a week. It's myself and one of my colleagues, and we go through the details of how it works. But I really want to make sure there's one point I make, and Emmanuel and I joke about this, but listen, if you got a lot of money, there are a hell of a lot of people that want to tell you how to spend it. And I'm a little bit of a purist and traditional this way. One of our credos is our goal truly is to help buy back America one family at a time. Because I'll tell you one thing that, and this may ruin your day, I'm afraid, but do you know where the word mortgage comes from?
It's dead.
Close. Death pledge.
Did you know that?
It's Latin.
Mortician,
Mort and
mort
pledge.
is in French means dead.
That's right.
And then
Death
gauge.
pledge. So most people end up taking that same 30-year mortgage
the
and refinancing
grave.
over and over and over again. So our whole point is we're just kicking the can down the road. Our country does it, companies do it, and Americans do it. The difference is the government can print their own money. We can't. If we don't start making more serious commitments to get America more fiscally sound, and I'll never blame this on it, but one of my best friends in the world lost his job and committed suicide. And one thing we know for sure is that finances are at the core of a lot of struggles in families. Mm-hmm. And so one of our focuses is, it was great to be in the mortgage business. It's a phenomenal tool. I was thankful to be in the insurance business and things like that. But debt is probably the single most crippling thing that affects mm-hmm. the stress and strain of the average family. Mm-hmm. And it does not have to be that way. So yes, the banks have their own agenda, but I'm telling you fundamentally, we're going to change it. I was doing an event out in California a couple years ago, and I said something to that effect. And I had somebody come to me after and said, oh, that sounds so great, or you really think you can do that? I said, no, we're going to do it. We're going to fundamentally change the way that people look at their finances and allow the average person to fundamentally bank like a bank. So now you don't have to be wealthy. You don't have to be the elite. We can show somebody as little as $1 a month how they can take control of their finances. And when they can see that something they thought was impossible is now achievable, you would be amazed at how people will begin to make fundamental shifts in their life. That $29 subscription they didn't see, that storage unit with junk they don't even use anymore, all of a sudden removes 6 months, 9 months, a year and a half, 5, 6, 8,000. And when you're on a diet, the better you look, are you more motivated to work out or less?
Much more.
The more you lose, the better you do, the more progress you make, the more you're motivated. And that is probably why the dashboard, as silly as that sounds, I mean, we spent $20 million developing this platform. So with all the algorithms and all the math, that's great. But the dashboard, the visual ability is what is the game changer. And I think the last thing I would say as it relates to, you guys
just need a really cool name, like Simple Sarah for the basic package. And then what are we going to name
Sarah wants to get paid on this one.
You should probably look it up. I think I'm going to buy the website if it's available.
I think we should probably just trademark
Simple
that
Sarah,
right now.
then I'm just going to put Sarah's picture.
What's the progressive insurance girl?
What's her name?
Flo?
Flo. So I can be the Flo of...
Listen, we'll do a little mini green screen, black screen podcast with you, and we'll talk more about it. But I will say this. Emmanuel and I talked about this, and one of Emmanuel's great strengths, every strength has a weakness, right? I think of him a lot like a doctor sometimes, right? God. Doctors don't always have the best bedside manner.
Amen.
But what I will say is that he's very much business-minded, and here's what's happening. Somebody has to disrupt the industry. Mm-hmm. Because otherwise, you guys have to compete on what? We have the best smile, we have the best service, nobody can always have the best plan, the lowest cost, and the lowest rate. What's the real value prop? So what if you had somebody call right now and Sarah calls and says, hey, Emmanuel, I'd really like to refinance, theoretically. And Emmanuel says, hey, yeah, that sounds great. Would you like to refinance as a 15-year or 30-year? She goes, 30. What if you said...
Well, that's not what I said, by the way. The first question...
I'm paraphrasing, clearly.
No, I get it. But to your point,
is that
the very first question I ask is I say, what are your goals?
Yep.
What are we trying to accomplish in this refinance?
Good.
Hey, I'm selling my house in 3 months, and I want to... You know what? This isn't the right thing for you to do.
He is more of the consultant. I will give him that, and I will stick up in this podcast world. I
have no doubt, and I agree because he's worked with a lot of my clients, probably dozens and dozens. But what if you now said, once you got to the conversation of what strategically we were going to do you want the traditional 30-year, or do you want a 30-year utilizing a program to pay it off in a third of that time? My whole point is, it is a completely fundamentally different conversation. For those of you that are in the real estate industry, this is really game-changing, because if Sarah had been in the business for 30 years as a real estate agent, and I've been in the business 3 months, and you're a client that we're both trying to win over, I'd be like, well, Emmanuel, I can't compete with her 30 years of experience and all of her knowledge. But let me tell you the one thing I'm going to do for you that nobody's ever done for you before. Not only am I going to help you find your dream home, I'm going to help you own it free and clear in a fraction of the time. And my point is, in that moment, my value prop went through the roof because nobody's ever said that before. And they're like, wait, what are you talking about? It is all about how do we begin to change the conversation and engage at a different level with clients. And I'm telling you, this will revolutionize the way we engage, because financial planners show us how much money you got to invest or pay for insurance. Mortgage guys, it's about the loan. Real estate, it's about the house. What about the average family's day-to-day experience with managing their finances and getting out of debt? That's a game changer, and it's ubiquitous across the board.
From a business standpoint, you just got to make sure that Basic Bobby and Simple Sarah understand the product. They understand, as long we got to get the elevator pitch to be short, to be concise, and for the Simple Sarah and Basic Bobby to understand it, because it is the longer that you make it, the harder it is.
Here's simple. Would you like to get out of debt faster?
I love it.
Right. How can I get more?
Simple Sarah's going to bring it home.
Awesome. Well, Rich,
I have no doubt. Sarah's a superstar.
let's get this wrapped up.
Sure.
We're going to put Rich's contact information and in the show notes. Simple
The link
Sarah.
for the webinar.
Sure.
Maybe we might, by the time this airs, maybe I'll own a website called simplesarah.com and basicbobby.com.
It keeps sounding like syrup, like simple syrup kind of Sarah. I don't know why that keeps coming to my mind every time I
I
hear
don't
it.
like syrup.
But
Well,
Rich,
yeah.
always a pleasure. Thank
Fantastic.
you
Thank you.
for being on the
Thanks
show.
for being on.
You guys keep doing an awesome job. I will tell you as a plug, and it's not even solicited, I think Choice is by far and away the overall best managed mortgage company and lender that I've ever worked with because everybody's in-house.
Thank
I
you.
like to know when there's a problem, I can knock on somebody's door. And I like the fact that everything can be done, and Emmanuel, you run a great ship. And
Appreciate
I think that incorporating things that can provide even more value to clients is a win-win all the way around.
We love
Awesome.
a win-win. Thanks, Rich.
You're welcome. Thank
Thanks.
you, guys. Appreciate it very much.
Okay, that's enough whining for one day. We are so happy that you could join us today on Stop Whining About Real Estate. So please, not only listen, but subscribe, follow us, download, share, and if you're feeling it, give us a 5-star review. Hey, and if you'd like to be a guest on the show, please email stopwhining@choicemortgage.com. Thanks so much.